Hello there, and welcome to health insurance. Now, I know some of you guys that are here with the course are going to be taking a health-only exam, and some of you guys are continuing on from life insurance here to health insurance. I would like to welcome you here to class, for those of you that are new, and say hello to those returning students continuing on from life insurance. My name is Scott Schultz, and I'll be the instructor for the health insurance portion of the course here. And we're going to start off in that textbook the section that you printed off from the PDF portion of the site, which is called Disability. You see at the top of the page, Disability, Accident, and Health Insurance Basics. So we're going to start off in this section doing a broad overview of the various different types of health insurance policies, how they work, and a lot of definitions kind of as an introduction to the course. Now, those of you guys doing health insurance, this will be your second section that you will be studying. Should have already watched the general insurance video and continue on here to health insurance basics. And so we will get started here, and we'll start off with a couple different types of definitions. And the first one we have here is the definition of peril. Peril is defined as a cause of loss. So, when we talked about life insurance, there's basically only one covered peril. What was that? It was death, right? So in life insurance, we only covered one thing, and we were covering death. So in reality, that was the only covered peril. That's all he had to worry about. Was the loss covered? Well, did a person die? Well, that's the only covered peril in life insurance. Well, we get over to health insurance, there's a number of different types of covered perils. So we'll get into those at the start of the section. There are certain types of health insurance policies that actually cover death. Okay, so back in life insurance, the covered peril was death. So really, they should call it death insurance. However, we don't really want to call it that and make it hard to sell, right? So we call it life insurance. Well, here over on the health side, we are insuring a couple different types of losses. So we have basically two different covered perils in health insurance. We have, number one, accidental injury. And we have number two, sickness. So, there's some terms you need to be familiar with right before we start the section. Now, in general, we call this the health part of the course, right? Because we are covering health insurance. Well, on the exam, they don't always refer to it as health insurance. Sometimes they refer to it as disability insurance. So you have to be familiar with these terms. Now you see at the heading right at the first page here in the section says Disability, Accident, and Health Insurance Basics. Well, sometimes referred to as health insurance, sometimes referred to as disability insurance, and sometimes referred to accident and sickness insurance, or accident and health insurance. And sometimes they just abbreviate these A&H or A&S. Okay? These are all different terms that refer to the same thing. Now, in real life, when somebody says, do you have health insurance? Generally, you're going to think of a policy that covers doctors and hospital bills. That's a type of health insurance policy, or a type of disability insurance policy, more specifically called medical expense. Okay? Now, sometimes on the exam they say, in a disability, accident, and health policy, that's just a generic question about a health insurance policy in general. However, you're going to have specific questions that ask about this policy right here, which is called disability income. This is a specific type of disability insurance policy. And disability income replaces your lost wages if you should become disabled. So what type of perils are we looking to insure here? Accidental injury. I become disabled in an accident and can no longer work, maybe a car accident or something. Or sickness. I become unable to work because I get valley fever. Okay? That's a very severe sickness. I could possibly die from this, but probably going to be in the hospital for a certain period of time, or bird flu. I mean, you hear about these things in the news, but hey, this could happen. That's a sickness. And if I have a health insurance policy, sicknesses are covered. Certain types of health insurance policies also do cover death. One thing I'll make clear though, health insurance never covers death due to sickness. That's life insurance. We will talk about a couple types of health insurance policies that cover death due to accidental death. Because remember, back in life insurance, we talked about a rider you could add to your life insurance called accidental death benefit rider. Pay double or triple the face amount if a person died in an accident. That's a type of health or disability insurance policy. Okay, so we'll learn about that actually here in this section. Now this section usually has a lot of questions on the exam. However, remember it's going to depend on the state you're taking the exam and the outline that you printed off from the PDF section that will tell you how many questions you're going to have from each section. So just take a look in there and note in this section how many questions you're going to have. Okay, this stuff being said, as we know already, definitions are very important. Okay, so you have to know what the words mean. So we'll get this stuff out of the way, and then we'll go ahead and take a look here in this section, starting with the first page. So I am on page 111 here in the book. Take a look at the very top of the first page. It says in the first sentence, highlight, star this, a peril is defined as a cause of loss. You've got to know that definition for certain. When discussing disability insurance or health insurance or accident and health or accident and sickness insurance, you should remember that disability insurance covers two specific perils, so put a star by these. These are the first two things we mentioned there. Accidental injury or sickness. And it says the words disability or health insurance could mean any of these 5 types. So here are the main 5 types of health insurance policies that we'll learn about, or disability policies we'll learn about today in this course. And they have 1 through 5. Number 1 we already mentioned, disability income insurance, replaces your lost wages if you should become disabled. Number 2, accidental death and dismemberment. This is a form of accidental death benefit rider that I just mentioned. This is a type of health insurance that covers death, only due to accident though. Remember, health insurance never covers death due to sickness. Okay, so we've got number 3, medical expense insurance. Okay, now here's the one that most people think about. Somebody asks you, I said, do you have health insurance? You think, yeah, I have a policy that covers doctors and hospital bills. It's actually a medical expense plan. So there's a couple of different versions of medical expense plans that we'll talk about later on today. Number 4, dental insurance. Very similar to medical expense. It's just we're covering expenses related to dental procedures. And number 5, long-term care. This is a very important type of coverage because this will provide coverage for the cost of custodial care in a nursing home. And basically that's full-time nursing assistance with the activities of daily living for an individual, and this is very expensive if you don't have this coverage to pay for on your own. But essentially, you end up in a nursing facility and you no longer can care for yourself, possibly maybe have Alzheimer's, or maybe you're young and just have become incapacitated due to an accident, and you need somebody to help you, feed you, put your clothes on, help you move around from your bed to your wheelchair. Okay, that's what's covered under these long-term care policies. So those are our 5 main policies. Now I want you to keep in mind, because we don't go into them too in detail here, that each one of these will probably have its own section in the book later. So we go in much detail when we get to the later sections and the later videos here in the course. Okay, bottom of page 111, you see in the center, principal types of losses and benefits. We have loss of income. Well, which one of those first 5 did we mention covers loss of income? Disability income. It kind of says it right in the name of the policy. You become disabled, it replaces your lost wages. So what's the risk you're worried about here? Well, everybody has debt. Okay, whether it's credit card debt, you've got a car loan, a home loan, whatever it may be, you've got bills that you have to pay. Well, what happens if you become disabled and you can no longer work? Say I'm out the weekend, I'm water skiing and I get injured and I can't go back to work. My disability causes me to be unable to work. Well, it didn't happen on the job, so I don't have any workers' compensation. Now, I might have a medical expense plan, but the medical expense plan doesn't replace my lost wages. That pays medical expenses. So if I had to be airvac to the hospital and had to have surgery at the hospital, some of those things are probably going to be covered by my medical expense. But what about my lost wages? I can't go to work, back to work now for 6 months, meaning there's not going to be any income coming in for me to pay my bills. Well, that's what this policy is specifically created for. That's that risk. I'm worried about becoming disabled and not having any income because I can no longer work. The disability causes me to be unable to work. Well, I can buy disability income. So covers a loss of my wages. This could be in an individual policy or in a group policy. Maybe an employer provides this for their employees. And it says there, the third paragraph from the bottom on page 111 says, the first sentence, disability income insurance is a coverage that protects against loss of your net earned income in case you become sick or injured and cannot work. So just like we said, whether it's related to a sickness or an accident, you become disabled, you can't work, that's what this policy is there for. Now, back in life insurance, we said in order to submit a covered claim, you had to prove that a person died. And the proof of loss you submit is the death certificate, okay? So, you know, a person's either dead or not. Well, when we talk about submitting a claim on disability income, it's kind of a gray area here because you have a lot of people that might try and fake a disability and try and take advantage of collecting on a claim when they're not necessarily really even disabled. Okay, so if we have a claim under this disability income policy, in order to collect on that claim, a lot of times the insurance company will request that we go see their doctor. Their doctor. They pay their doctor, we go see their doctor checks us out, maybe has us do a physical exam, and determines if we are disabled, what type of disability we have, and whether we're eligible for benefits within our policy. So when we buy our policy, it says right in there, in order to be considered disabled, this disability has to cause us to be able to not perform our job. So we're going to have a definition right in the policy that we have to meet. Not only are we disabled, but our disability has to cause us to be unable to perform our own job, depending on the definition in the policy. Okay? So that's how we would try and prove that we're having a loss and collect on a claim in a disability income policy. So just a little bit different than life insurance. So you see, second paragraph from the bottom on page 111, it says the second sentence, which is very important, so highlight or put a star by this. Definition of total disability will vary by company. Although the typical definition of total disability requires that the insured be, here's the typical definition, but it's different company to company, unable to perform his own job for the first 2 years and any job they are suited for based upon their education, training, or experience after the 2 years. So for the first 2 years, you have to be unable to perform your own job, first 2 years of your disability. After those 2 years of time has elapsed, then you have to be unable to perform any job that you're suited to do from prior education, training, or experience. So again, we'll talk much more in detail about this when we get to the disability income section. Bottom of the page, we have medical expense. So there's basically two different types of categories of medical expense plans. We have the service plans, which are the HMOs and the PPOs, and we have the reimbursement plans, which are also known as the indemnity plans. Now, the first ones to come about when medical expense insurance was created were the reimbursement or indemnity plans. Then over a period of time, we had the creation of the HMOs, the service plans, where you pay a fee for your service. You pay a monthly premium for coverage. Then when you go to the doctor, you pay what's referred to as a co-payment. So most everybody's familiar with that terminology. And again, we'll see this a little later on. It has its own section in the book, so it's very important. But last sentence says, this coverage may be sold on a reimbursement basis or indemnity basis by a private insurance company or on a service basis by a service organization such as an HMO, also PPOs. We go on to the next page. At the top of the page, on page 112, it says dental expense. Well, dental expense, as I already mentioned, is very similar to medical expense. So in fact, if you have any questions on dental expense on your exam, which you'll probably have a few, I would answer them the same as you would a medical expense question. So you could buy medical expense and dental expense insurance on a reimbursement basis, or dental expense you could also purchase on a service basis. So they have what's called prepaid dental plans, which work very similar to an HMO concept. So again, later on, we'll get more in detail into that. One thing they'll mention there, which is important, so highlight the first sentence, says dental insurance is usually sold on a group basis in order to prevent adverse selection. Now, could it be sold on an individual basis? Yes, but it's usually sold on a group basis. And going back to adverse selection, the insurance company, adverse selection from their standpoint is when only the people that are going to have claims are buying insurance. So in dental expense, keep in mind, we've got a long list of different types of insurance that we need. You know, we need renters or homeowners insurance, we need auto insurance, we need medical expense insurance, maybe some life insurance. Okay, well, there's 4 or 5 different types of insurance right there. We've got, we'll talk about long-term care here today. Dental expense insurance is, you know, quite far down on the list of different types of insurance that we have to purchase. Okay, now when am I going to buy this? Well, I go to the dentist and I find out that I have to have a root canal and I have to have a crown put on and it's going to cost $2 grand. Hey, I might as well go out and buy some dental expense insurance. Well, that's adverse selection. So there's going to be underwriting, a lot of underwriting, which we'll learn about here in this section, on individual policies, more so than group. Okay, so in order to prevent adverse selection, dental expense insurance is usually sold on a group basis. Could be sold on an individual basis though. Let's see, last sentence in that paragraph, it says, dental expense insurance also can be integrated with a medical expense plan. And the benefit of that, having an integrated medical and dental expense plan, is the deductible in the plan can be satisfied with either medical or dental expenses. We'll talk more about that later. Then we go into long-term care expense in the second paragraph on page 112. So long-term care pays for a number of different things, nursing home care, home health care, but essentially this is for a person who can no longer take care of themselves. So they need help with what are called the activities of daily living: eating, bathing, dressing, ambulating, which is moving around, generally taking care of oneself. If a person needs help with that, they're going to have to pay someone else to do it, and possibly if they go in a nursing home, this could be very expensive. So when we talk about custodial care, which is full-time nursing care, most types of programs such as Medicare do not cover custodial care. And in fact, the only area that we'll see custodial care covered at all in health insurance is going to be in a long-term care policy. Keep in mind though, it's insurance, so it's going to have policy limits, periods of time that you're covered, maximum coverage periods. So again, more in detail a little bit later on. So it says in that paragraph though, first sentence, put a star, highlight that. Insurance that is sold by private insurance companies to cover the cost of convalescent nursing home care. Very important. It says, in fact, in the center of the page, most people who are confined to nursing homes are covered by Medicaid, which is a public assistance welfare type program for people with little or no assets or income. Medicaid is funded by the federal government but administered by various states. Medicaid is not part of Social Security, so highlight that. So there's a couple things that are very important there in that section that we have to understand right off the bat. Long-term care. This policy is sold by private insurance companies. This type of coverage is not provided in any other type of policy, and custodial care is not covered under Medicare at all. Okay, so if you need it, there's only two things that will cover it. Medicaid, which they mentioned in there. Medicaid is essentially medical welfare, and depending on the state that you're in, they have a different name for it in every state that you're in. Okay, but Medicaid's the federal name for it. Money is put up by the feds and by the state, and it's medical welfare. So it covers a number of different things, but one thing it does cover is custodial care in a nursing home. So if you're in a nursing home, you're either paying the expense yourself out of your own pocket, you have long-term care that's providing some of the coverage, or you've exhausted everything you have, you're still in there, and you're covered under Medicaid. Now, in order to buy long-term care, you do not need to be 65. You can buy it, at any age. A lot of companies, you have to be a minimum age before you're eligible to purchase it from them. But you don't have to be 65 is the key. Medicare, that federal health insurance for people 65 and older, you have to be 65 to get Medicare for most all situations with some exceptions. Medicaid, medical welfare, you do not have to be 65 to get Medicaid. And Medicaid is not part of Social Security. You have to have basically no income, no assets. Okay, so that brings up a lot of important notes. These are all things you need to know for your exam, but that are kind of briefly mentioned there in that page. Now we go in the heading on 112, classes of health insurance policies, individuals versus group. Okay, so a couple important things that we'll mention here, kind of review from life insurance, but remember, individual policies, a lot more strict underwriting. There's a lot higher chance for adverse selection in an individual situation versus group. Where in group, generally there's low or no underwriting, because remember, if the insurance company requires everybody to go do a physical exam, they have to pay for it. So it's a cost of their underwriting, so it would be very expensive. Okay, so most times there's low or no underwriting in a group situation, but there are what we call participation percentages, which the insurance companies created to prevent that adverse selection. So what that means is a certain number of eligible individuals in the group have to enroll in the coverage. Okay, so that's kind of reiterates that back from life insurance. We go to the bottom of the page, 112, private versus government. We kind of already talked about that. Most of the policies we've talked about so far are sold by private insurance companies. Disability income, medical expense, dental expense, long-term care. Those are all sold by private insurance companies. Government programs, Medicare, health insurance for those 65 and older, part of Social Security, and Medicaid, medical welfare. Don't have to be any age, just have to prove that you don't have any income or assets, primarily. And limited versus comprehensive, we'll get much in detail into that later, but on the next page, that kind of is a good segue into our next page, on page 113 at the very top, we have what's called limited policies. Now, you're probably going to have a couple questions on these on your exam, 1 or 2 depending on your state, possibly 3 at the most. But with these limited policies, there's 2 reasons they call them limited. There's limited coverage amounts, dollar amounts, that are stated right in the policy, and there's limited covered perils. And it specifies right in the policy what perils are covered. So limited policies, low coverage amounts, lots of exclusions, and only a limited number of things that are going to be covered. Now at the top of page 113 in that first paragraph, there's this term that you see, principle of indemnity. Now, principle of indemnity is something we talked about over in life insurance, but in case you're new here for health insurance, principle of indemnity states your insurance is not for profit. So it states your policy will pay your loss or the policy limit, whichever of the 2 is less, and that you cannot profit from insurance. In fact, that your insurance is there to make you whole again after a financial loss, to fill in that hole that that loss created. Well, the reason I bring up principle of indemnity again is it's very important here in health insurance, because most all policies in health insurance follow the principle of indemnity. And they will do anything they can to try and prevent a person from profiting from a health insurance policy. Well, the reason I bring it up and go into detail there in it is you'll see at the top of page 113, these limited policies do not follow the principle of indemnity. That means you can potentially profit from these policies. The insurance company doesn't care. They don't follow the principle of indemnity. It doesn't matter. Now, these policies usually are very cheap, and they're primarily sold by what they call direct response marketing, which is through the mail. Okay, so in the first paragraph on page 113, in the second sentence, highlight this. These types of policies do not follow the principle of indemnity, which means that they all pay in addition to each other and, in fact, any other policy that you may have. Okay, so we have types of limited policies. Number 1, accident only. And we have this policy called accidental death and dismemberment. So, covers 2 things. As stated right in the policy, you die or you become dismembered in an accident. So it covers 2 things, accidental death or dismemberment. And it'll state you buy the policy. We have listed right in it, we have the principal sum, which pays for death and severe dismemberment, and we'll say it's $1 million. And we have the capital sum, which pays for dismemberment, and it's usually listed as 50% of the principal sum. Okay, so the principal sum, as you'll see there, number 1, is the amount that pays for death or severe dismemberment. In my example, say $1 million. Capital sum is the amount that pays for dismemberment and usually is listed as 50% of the principal sum. So, let me give you an example. I have this policy, and as I'm driving home here from this taping session for this class, before I get on the freeways, and the freeways where we live here are very dangerous, and it's always gridlock, as it is in most states here in the U.S. And before I get on that freeway, I go in the bathroom and I smoke some crack. Okay? It gets me, hyped up for that drive home and gets me ready to deal with what I have to go through to get on that freeway and get home. Okay, so I smoke my crack and I'm on my way home on the freeway, and I get in a car accident and I die in the car accident. And I have this policy and you're my beneficiary. The beneficiary is the person who's going to get this death benefit. Okay? So I've got this accidental death and dismemberment policy. $1 million, okay, amount of coverage for accidental death, principal sum. I die in an accident and you're the beneficiary. So you turn the claim in. Is that covered? What do you think? It was an accident, right? I died in an accident. Is that going to be covered? No. Why? Because I was on drugs. So how are they going to figure that out? Well, number 1, they know me. Okay, they know that I'm a crack addict, right? So they figure, oh, well, great. Scott was probably smoking crack again. And not only that, but in the accident, my whole crack stash I keep in my trunk, flew all over the freeway. So the police, when they were doing their investigation, they make note of that in there. Plus, they might do an autopsy. Okay, so where it's allowed by law, the insurance company is going to do an autopsy. Why? Because they don't want to pay the claim. Okay, if it's excluded in the policy, and exclusions are things that are never covered, they're not going to pay the claim. What's one of the exclusions in this policy? If I'm under the influence of alcohol or drugs, when I die or become dismembered, no coverage. So right there was a situation where I died in an accident, which says right here is covered in the policy, where I wasn't covered. Okay? So you see, that's why they call these policies limited. Lots of exclusions. Okay, so we'll take a look there in the book on 113. It says, number 1A, accidental death and dismemberment. Number 1, principal sum, so put a star by there, pays for death and severe dismemberment, severe being such as the loss of 2 limbs. Number 2, capital sum, pays for dismemberment such as loss of a limb. Capital sums usually written to be 50% of the principal sum. The next paragraph it says, as with most limited policies, AD&D contains many exclusions. Primary exclusions, being under the influence of alcohol or narcotics at the time of the accidents. Shouldn't have smoked the crack, right? In addition, AD&D policies do not cover occupational or military-related accidents and do not cover loss of digits, such as fingers and toes. Loss of a hand, for example, is covered if severed above the wrist. Since coverage is very limited, premiums are low. Now notice we said here, dismemberment. What's dismemberment? Your arm is cut off. We're not talking about you get injured in a car accident, you have nerve damage, and you can't move your arm. That doesn't count. We're talking about a tiger gets loose from the zoo, chases you down, and eats your arm off. Okay, that would be a dismemberment. Or you're out working in the shed in the backyard doing some woodwork, and you saw your arm off. Now notice it says right there, if you saw your fingers off, that's not covered. We're only going to cover something if it's severed above your wrist. And the more severe the dismemberment, the higher they'll pay. So if I lose it above my elbow, well, that's more money for me. If I lose it above my wrist, less money. If I lose my fingers, not covered at all. Okay, so pretty strange policy, but it provides an additional amount of coverage, and a lot of times you have this coverage built in on such things like credit cards. They call it what's known as travel accident. If you book your flight on like a Discover card, as a member benefit, they'll add maybe $10,000 of travel accident insurance. So I said earlier, there's a couple policies in health insurance that cover death. Here's one of them. And in fact, there's only 2 of them. And they only cover death due to accident. So we have accidental death and dismemberment. We have the next one on the page, B, travel accident. So here's the one I kind of just alluded to. Travel accident only covers one thing. We said it covers accidental death, but only from one cause, plane crash. And we're talking about commercial airliners. So where do you see this sold? Right in the airport. So you go down, me, I don't fly, I never fly. Okay, I'm totally frightened of it. Had a bad experience, thought a plane was going to crash, never fly again. Okay. Now, if I was to fly again, I could buy life insurance for the flight. I'm so worried about the plane crashing. I know it's pretty much a certainty it's going to happen if I ever fly again, so I might as well buy one of these policies. Where can I get it? Right at the airport. I was going through LAX a couple years ago, 4 or 5 years ago, and there it was. Right at LAX, they had Los Angeles International Airport. They had one of these. It was a vending machine selling travel accident insurance. So how do they sell these? Well, you're nervous. You're just about to board the flight, and they've got this little vending machine right next to the Coke machine there, and it's got a picture of a 747 on fire, going down, and it says, "This could happen to you," right? Well, it's kind of like shock advertising, but you buy one of these. You pay, just cut a check, fill out the form, there's no underwriting. Your name, how much coverage you want, cut the check, put it in that receptacle there with the vending machine, and the plane crashes, then that amount gets paid out by the insurance company to the beneficiary you listed on there, no tax on the death benefit. Okay, it's called travel accident. Had a guy in my class a few years ago, actually in California, who said he always bought these policies, something like $35 for $500,000 of coverage. Get this though, It only covers one flight. So a lot of times you might have to transfer somewhere. Say I'm flying from New York to Washington, I might have to stop halfway and catch a transfer on another plane. Well, I would have to buy 2 policies, because when I buy the policy, it only covers one flight. So from takeoff to landing. We land, policy's over, the insurance company keeps that premium and they don't have to pay out a death benefit. Okay? So you see there, that's travel accident. Notice last sentence says, this insurance does not cover military travel, also doesn't cover private planes, only commercial airlines. And we continue on with these limited policies. We have number 2, specified dread disease, second paragraph from the bottom on page 113. This is a very well-known type of limited policy, such as cancer insurance. So direct response marketing, you get a letter in the mail that says, 3 out of 4 Americans get some form of cancer in their lifetime. Wouldn't you like to have an additional coverage for $2 a day or whatever? They're marketing a limited policy to you. So no underwriting. You just fill out the information, put a check, mail it back, you've got your policy. And it states if you get cancer, remember, it only covers one thing. You buy a cancer insurance policy, it will only pay if you get cancer. If you don't get cancer, it's never going to pay. So you get cancer, it'll pay a certain dollar amount, usually per day, to pay for your cancer treatment. But it pays in addition to any other coverage you have. And these treatments, are going to be very expensive. So, heart attack insurance, stroke insurance, cancer insurance, these are all different types of dread disease policies. And we have at the very bottom of the page 3, hospital confinement indemnity policy. It is just what it says, a limited policy that covers if you're confined in the hospital. So if I buy this policy and I'm never confined in the hospital, it's never going to pay. But for example, say I buy this policy and I get in a car accident and I end up in a coma in the hospital for 6 months. Okay? This policy will pay. It'll pay a certain dollar amount per day to be used to help pay for my hospital expenses for the confinement. Now, trick question though. If it's there, you might see a question on the exam that says, all of the following health insurance policies follow the principle of indemnity, except. So what policy doesn't follow the principle of indemnity? If hospital confinement indemnity is listed there, that's going to be the answer. Now it's tricky though, because it's right in the name of the actual policy, hospital confinement indemnity. Well, it doesn't follow the principle of indemnity though. It's a limited policy, so it pays in addition to whatever other policy you have. So it's kind of confusing there, I know. Now we go on the top of page 114, number 4, credit disability. Credit disability kind of relates back to credit life, because usually they're packaged together. But here's the risk here. We become disabled, we can no longer work. We buy credit disability, covers specifically that risk. It will, depends on how it's laid out, but a lot of times it will make our monthly payments on our outstanding debt for us while we are disabled. So it's called credit disability. A lot of times packaged and sold at time of obtaining a loan. A lot of times sold by those bankers. So we've got number 4 there. Last sentence says, in fact, creditor is both the policyholder and the beneficiary of the policy. Although the debtor, the person borrowing the money, pays the premium, generally it's just loaded into their monthly payment on the loan. Number 5, blanket disability, another limited policy. This would be sold to maybe somebody who operates a summer camp where they have kids coming out. Say I operate a summer camp where we do Little League baseball training for kids. And I'm worried about one of the kids getting injured at the camp while they're under my supervision. And possibly the parents suing me because of that. Well, I buy a blanket disability policy. It blankets everybody. So I don't need to specifically name each participant by name. It just throws a blanket out there, covers everybody. If they get injured out there, this will pay a certain dollar amount to help pay for their medical expenses. It's a goodwill type gesture, and I'm hoping by doing this that the parents won't sue me. Okay, so we've got blanket disability. 6, prescription drugs, just what it is. We see a lot of these health insurance policies, very limited coverage, if any, for prescription drugs. You want some additional, you could buy a supplementary policy covering that. And 7, vision care, same thing there. You buy this, it'll cover, you go to get your eyes checked, maybe a pair of glasses every year, every 2 years, depending on how it's laid out there.